Yeah. So anyway, thanks for coming in tonight. So as usual, today I have actually a lot of content to actually share with you guys. For people who are totally new, don't worry about it, because all these concepts I actually put it into something that is easy to understand. All right. So even for people who are laymen, you will be able to benefit from it. All right. So I just want to make sure that I mute everyone first. Okay. Okay. Yes, everyone is muted. Okay, let's get started. Cool. So before I start, I just want to show a very quick introductory video about myself for those of you who have not met me before. My name is Borwen. So just enjoy this very, very short clip. Yeah. And later on, if you have any questions, just feel free to put into the chat group. Manage the downside and the upside will take care of itself. Okay, but before I start, I just want to put this slide very, very important, which is a disclaimer. Okay, whatever that is shared actually today does not consider each and every individual risk profile and risk level. So should you use any information here, okay, you are fully responsible for your own investment and actions. And again, by staying on in this video, you agree to the condition that the speaker will not be held liable for any of your losses should you use any of the information in here. All right, why am I putting this right in front? Is because later on, okay, I want to go all out. So I want to share with you as much real companies as possible. Okay, so for me to actually share all out all the companies, a lot of real case studies, I just want to make sure that we actually put this right in front. So why is this important? It's because when you actually make money, okay, whose credit is it? It is actually your own credit. Because why? You are using your own money to make money. Okay, that is your own money. That is your hard-earned money. But the problem is, if let's say today I share with you a company and you actually bought and you lose some money, so who are you going to blame? Okay, probably some of you will say, oh, I'm going to blame Bowen because I actually bought it because after watching his video. All right, so once again, just a quick disclaimer so that I can go all out and share whatever I want to share with you guys today. Right, so I hope that you guys actually are aware that right now, okay, in Singapore and across the world, we are facing something that is really, really important. Okay, so over here we have early, mid, late, and of course this very, very important words, which is recession. So I'm not sure whether how many of you guys already experienced this thing of a recession going on right now. Okay, but what happened is that you can see from this particular chart, when you have a recession, you are looking at rising unemployment rate, declining activity, contracting profits. Business are going to make less money. Some of them are even going to lose money. And of course, central bank policy is going to ease, which means that the government is going to actually like print money, which we are seeing a lot right now. So this is happening right now. We are in the midst of a recession. In fact, I would say we are just starting. We are at the front end of the recession. So there is actually still a long way to go. We are looking at least a 6 month to 1 year, okay, of a recession. So for those who are still not aware that we are in a recession, okay, this is very, very important. So what happened is that when we talk about recession, you know, some of you might find that it is very complicated. How do you mix recession with business, with stock market? So basically, this is my economic cycle. I just put it into very, very layman terms for you guys to understand. So what happened is that there must be a triggering event that happened. So we know that right now what actually triggered is actually this COVID-19. Okay, there is actually a health crisis going on. So because of this virus that is going on across everywhere, across the whole world, business are affected. Okay, people are not going out, people are not spending, airlines have actually stopped, many things actually are affected. And because of that, the stock market will go down. So later I will also explain more why when the business are affected, stock market will go down. And when the stock market goes down, retrenchment start. All right, so what happens is that when retrenchment starts, what is going to happen? You guys can see that people are going to spend less. Okay, when people spend less, more business are going to be affected. And when more business are affected, the stock market goes down even more. So you can see that there is a cycle that is going on. Okay, and then again, when the stock market goes down, business are affected, there will be more retrenchment. So what is the triggering event right now is actually the COVID-19 that is going on. And because of that, business are affected. But I would say the business affected is not the key impact. The key impact comes when there is unemployment rate. When the business are not able to employ people, they are going to retrench people. So those people who are retrenched, what are they going to do? Okay, maybe for the next 3 months to 6 months, they will be looking for a job. But when everybody is retrenched, having retrenchment, nobody is going to hire you. Okay, and the next thing is you still need to survive, but you probably will spend less, a lot lesser. All right, so right now, what I am monitoring across everywhere is I'm actually looking at the unemployment rate, okay, in US as well as in Singapore, as well as India, Hong Kong. So this is the key thing that I'm actually looking at, which is unemployment rate. Because once you see the rise in unemployment rate, the whole thing will actually start to collapse. So that's very, very important. Right, so you can see actually in China, this has already happened because why? The COVID-19 actually affect China first. So this was published actually about last week. About 5 million people in China lost their job in the first 2 months of 2020. And again, in Hong Kong, you can see that the Hong Kong unemployment rate peaks in over 9 years. All right, so this is happening in Hong Kong. This is happening in China, massive unemployment rate. Okay, and not only that, you can see that the government is actually printing more money. So there is an easing of the monetary policy. So Bank of England, you can see that they offer this thing called unlimited QE. So QE stands for qualitative easing, as you can see on the right article. It means that basically government are printing money. Okay, government are printing money. So England is printing a lot of money. The Federal Reserve, which is the US, is also printing a lot of money. Then we can see that even in Europe, the European Central Bank is launching a 820 billion pandemic QE program. So Europe is printing money. Poland, okay, even in Poland, they actually introduced the first QE program. So they also started to print a lot of money as well. Australia is also doing QE. Just for you guys to know that, in fact, Singapore is able to print money as well. So some of you guys that will be thinking, how come US is constantly able to print money? Okay, it is not true. Everywhere, every country is printing money. Okay, everybody is printing money, but how much are they printing? That is the important thing. So we can see this was published actually just today. Okay, the Senate passes 2 trillion coronavirus stimulus package, sending it to the House. So the US just approved a 2 trillion, okay, QE program. They are going to print 2 trillion out of thin air. So for me, I'm not used to looking at the word trillion. So I actually went to did a Google search. Then I realized that, I mean, as you can see, how much is 2 trillion? So 2 trillion is actually 2 million million. 2 trillion is actually 2 million million. So that is a lot of money. That is a lot of money. This is how much money the government is actually printing. All right. So what happened is that we understand that the stock market has been dropping. Okay, but why is it that the stock market always recover? It is actually because a lot of money is being pumped into the stock market. Okay, and when I say a lot, how much is it? As you can see over here, it is $2 trillion for today. But what happened is that the government has also mentioned that, okay, how much can they print? The answer is unlimited. So the US government is going to print unlimited amount of money. So this 2 trillion might be a start. They could print another 2 trillion, another 2 trillion, another 2 trillion. Okay, so when that happens, what is the impact going to be on the overall market? So by default, the US currency is going to become smaller. The US currency is going to become smaller. But as you can see right now, the US dollar actually strengthened. Okay, in fact, Singapore dollar to US dollar is about $1.45. It used to be about 130, but now it's about 140 something. So why is it that the US money is actually strengthening, although they're printing a lot of money? The answer is actually because people still find value in the US dollar. People are still buying a lot of the US dollar. So as much as everyone is printing money, most of the money actually still goes into the US market. And that is why when you look at the stock market, why is it that the US market always move in such a crazy amount? It's because all the money is actually flowing into US. So this is a very, very important chart I just want to share with you guys. So this is what happened back in 2009. So you can see at the point where I actually put the yellow circle. Okay, the first QE, after the QE was announced, you realize that the stock market didn't hit the bottom. It actually rebounded up and it goes back down even more. Okay, I repeat. So this is back in 2008, 2009, when the US government first announced that they're going to print money. So that happens during you can see that there's a valley. So when they released the news, the stock market actually bounced up because of the good news. Government is printing money. But what happened after that? Did it recover immediately? The answer is no. The stock market actually reversed and it went down even further. Okay. So that period, that process take about, I would say, close to about half a year. So what we are facing right now, okay, for those who are invested in the stock market, you realize that for the past few days, the market has been going higher and higher. So what we are looking at might be something that is very, very similar. The government has just announced that they're going to print a lot of money and we start to see the market recovering. So some of you might ask, Bowen, so is it a good time to start buying? Because I see that, you know, every day the share price is increasing. I don't want to miss this boat because if I miss it, I probably have to wait another 10 more years, which is 2030. Okay. So my personal take is history always repeats itself. So this is probably going to be the same thing again and again and again, which means that we should see a small rise and then the market will continue to drop down further before it will recover. So I actually put it over here. So when the market recover right now, okay, when it go up, so the next thing we want to look is the stock market will start to come down again. So that is where you can actually start to make a little bit of money. Okay, as mentioned in the PowerPoint slide, you can make some short-term gain. Okay, so how do you actually make money when the stock price goes down? Later on, I will actually share more. But basically, you can actually bet that the stock market is going to go down and you can make money out of it. So that again is a short-term gain because it happens maybe within a span of 2 months, 3 months, or even up to 6 months. But what is exciting, okay, why is it that as an investor, we are all very, very excited? Is because imagine right now we are at the bottom. Okay, we are at a place whereby the word QE1 expanded, the arrow pointing. If you actually buy your stocks right at the bottom, what is going to happen is you would have a long-term profits. Okay, you will be able to buy shares at a very, very low price. And when it recovers for the next 5 years, 10 years, you are going to make massive profits from the stock market. Okay, you are going to make massive profits from the stock market. So that is something that we are very, very excited about, right? So right now, I'm going to just focus on what is the key objective for today's masterclass. Okay, so 4 things we're going to go through. Number 1, we are going to understand what is investing. Okay, number 2, understand why people lose money from investing. And the third one is long-term investing strategy. Okay, third one is long-term investing strategy. And the last one is how do you profit short-term during the bear market that is happening right now, right? So I'm going to start with the basic first. We need to understand what exactly is investing. Okay, so to talk about investing, we need to learn from people who are actually very, very good at doing it. So one of the best, I would say the best investor out there is this gentleman called Warren Buffett. So as mentioned over here, he's actually worth 73.7 billion. That's a lot of money. Okay, so Warren Buffett actually built his wealth through this method called value investing. So today we're going to go in depth and understand what exactly is value investing. So value investing is very simple. Actually, what we want to do is we want to buy good businesses and we want to buy them at a sensible price. Okay, so two things that you must remember today. We want to buy a good business and we want to buy them at a sensible price. So actually it's the same as going to the supermarket. For example, today you want to buy vegetables. What we want to do is we want to buy a fresh looking vegetables and we want to buy the vegetable at a sensible price. So it's the same thing when we buy a stock. Okay, we want to buy a stock that is actually a good business and it is actually priced at a very, very sensible price. So two key elements over here. So let's start with the first one. When we talk about good business, so what is a good business? Okay, so let's look at this analogy. So today, if your friend asks you to buy over his business, what are some of the questions you will actually ask him? All right, so over here, I actually have a few answers for you guys. So some of the common questions that we will be asking is number one, what is the business? What exactly are you investing in? Secondly, how much profit is the business making? Because today when we want to invest in a business, okay, we want to invest in a business that is profitable, is making money, and not a business that is losing money. Number three, is the cash flow healthy? Okay, and of course, number four, what is the business growth plan? Okay, what is the business growth plan? So after I invest in this business, is it going to be stagnant? Okay, are you selling the business to me because it can't grow anymore? Or actually there is a lot of room to grow and there's a huge potential. So most of us will be interested when we go to invest in a company that has the room to grow. And number five, are there any debts in the company? Especially in current market situation whereby things are going to be very, very bad. Okay, debts are super, super important. Okay, so in a good market, debts is able to help you to grow your business fast. But when it comes to times like this, okay, debts are there to kill you. Okay, if a company has very, very high debts, we will probably want to avoid them right now. And of course, number six, what is the investment amount? How much money do I actually have to put in? And number seven, okay, very important question. Okay, although it's practical, but how fast can I get back my investment? How fast can I get back my investment? So let's start with the first one. Okay, what is the business and where can I get information on listed company? So of course over here I actually gave you a very, very good answer, which is this place called Google. Okay, so right now, in fact, every information that you want to find can be found on Google. Okay, including how do you invest in the stock market. Everything can be found on Google. But what is important is the skill set to know what to look for inside Google. Let me share with you. You can see that on the left hand side, on the right hand side, both are asking questions. But on the left, I ask, what does Facebook do? And on the right hand side, I type in, is it the right time to buy Facebook? So which one actually it is a better way to do? If let's say today I want to know what Facebook actually does, okay, should I type the left one, what does Facebook do, or should I choose the right one? Is it a right time to buy Facebook? Okay, so let's see which one is actually a better choice. So you can see that this is the difference between fact versus opinion. Okay, fact versus opinion. So what do I mean by this? On the left hand side, when I type what does Facebook do, pretty much if I look at all the 5 different search answers, it should be pretty similar. I would say 90 to 95% similarity. They will just tell you that Facebook is a website that, you know, connects people, it's a networking place. You can actually make friends, you can actually sell your product on Facebook. So it's pretty much the same because it is a fact. But on the right hand side, maybe the first post, okay, like over here, they say that Facebook stock falls after Q4 earnings beat. So this guy could say that, hey, because the Facebook stock has fallen, so this is a good opportunity to go in. But the second answers might show, no, it is actually not a good time to go in because it could fall further. So you realize that when you talk about opinion, everybody have their own answer. Even today, when we look at the stock market, I might be saying that the stock market would continue to go down, but I have a lot of friends who are telling me that the stock market is going to go up and bounce all the way up. So again, when we ask an opinion question, okay, you will get different answer. So what we want to do is we want to actually focus on typing the fact, okay, so that you get more consistency. So why is this important? Because instead of typing, can I buy Facebook? Is Facebook a good company? Can I buy Apple? Or even can I buy Alibaba? What are some of the facts questions that we can actually type? Okay, you can actually type in this. How much profit is Facebook making? Or how much profit is Apple making? So this is the fact. So which means that if you go to 10 websites, Okay, 9 of them should give you the same answer. Okay, the one that is wrong, probably they key in the wrong data, but pretty much it should be almost the same. So this is something that we want to look at. We want to look at the earnings per share of the company. So what exactly is earnings per share? Okay, basically we are looking at the net profit. Okay, how much money this company is actually making divided by the total number of shares. Yeah. So to put it into simple terms, when you see a company that has a positive EPS or earnings per share, the company is profitable. That means the company is making money. But if you find a company that has a negative EPS, it simply means that the company is losing money. All right. So are you all clear on this? Okay. Positive EPS means the company is making money. Negative EPS, it means that the company is losing money. So that is very, very straightforward. So when we look at this company, Sheng Siong Group Limited, okay, you can see that this particular screenshot show you from 2020 over here, all the way to 2011, 2012, 2013, all the way to 2019. So TTM stands for the last 12 months. In fact, it's actually until even this year. So this is the latest result. So what we want to do is very quickly, we glance through from the left to the right. Okay, under earnings per share, is this company making money every single year? So if you see something like this, every year is positive. Okay, and not only that, you can see that it actually grows a little bit. So of course, in 2010, they make quite a bit. But other than that, from 0.02, it grows to 0.03, then 0.04, and 0.05. So you can see that there's a growing trend of increasing earnings per share. So that is something that is good and something that we are looking out for. Okay, so first of all, it must be positive. Okay, preferably the earnings per share is growing. Okay, so year after year, the company is making more and more money. That would be the best. So this is for the profit. So the next question we ask, is the cash flow healthy? So again, you can just go to Google. What is the cash flow of Apple? What is the cash flow of Alibaba? Or what is the cash flow of Sheng Siong? And you should get all this answer. So for Sheng Siong, to look at the cash flow, we look at this thing called operating cash flow. So operating cash flow is just like looking at the bank account of the company itself. Okay. So when you see a positive figure, it means that the company is actually putting in more money into the bank account. So the bank account is growing. If you see a negative number, that means you see a dash followed by a number, it means that that particular year, they are actually giving out more cash. So the bank account actually reduced in cash. So what we want is we want to buy a company that has a positive cash flow. It's like your bank account. You want your bank account to grow year after year. Okay, more and more money inside your bank account. So if you look at Sheng Siong, just now we know that Sheng Siong is a profitable company. We look at the cash flow, we can see that the cash flow is healthy, it is positive, and every year it is putting in more and more money. So that is something that we are happy. Okay, next up. Okay, let's take a look. Are there any debts in the company? Are there any debts in the company? So when we look at debts, okay, there is this thing called debt over equity, debt/equity. So when we look at the debt, you don't need to look at all the years. You just need to focus on the latest quarter. Okay, focus on the latest quarter. As you can see over here, 0.1. So what is the number that we are looking at? Okay, so for debt to equity, it has to be less than 50%. Okay, so debt to equity must be less than 50%. So 50% on this particular website, it will appear as 0.5. So if you see this particular example, 0.1, it means 10%. So that is actually healthy. So anything below 0.5 is good. Anything above 0.5 is unhealthy. All right. So I just repeat, so far we have talked about 3 important things to look at in a company or in a business. Number 1, the company must be profitable. So earnings per share must be positive. Next, the cash flow must be positive as well. Okay, cash flow must be positive. The third one is the debt must be low. When we talk about low, we are talking at less than 0.5. Okay, debt over equity less than 0.5. And of course, number 6, what is the investment amount? Okay, so why is this important? It's because, right, knowing how much to invest could have a huge impact on the return on investment. Okay, end of the day, today when we invest in something, we want to make sure that it is growing. Okay, I put 10,000, the 10,000 must give me back in more than 10,000. Okay, if I put 10,000 and I get back less than 10,000, then I am looking at a negative ROI. That is not something that we want. So what happened is that, right, a lot of people, when we look at risk return, people always say that there's low risk, low return, high risk, high return. Okay, but what I want to share with you today, okay, is how can you actually achieve this thing called low risk, high return, right? So this is the case study that I'm going to show you. So let's assume that Mr. Ong, okay, is selling his bubble tea shop because he is migrating overseas, right? So his bubble tea shop is well known and has many regular customers. So every year, every single year, the profit from his bubble tea shop is 150,000 Singapore dollars lah. So now the question here is very important. How much would you be willing to pay to take over the bubble tea shop? Okay. So this is a very, very well-known business, very, very stable, many regulars. Every year consistently can make 150,000. So because Mr. Ong is going to migrate overseas, so he's actually selling away his bubble tea shop. So how much would you be willing to pay to take over the bubble tea shop? So today I actually put in 3 different figures. Okay, it might be the same as yours, it might be different, but let me just use these 3 to illustrate to you, okay, what do I mean by low risk, high return. So let's assume that somebody is going to offer 300,000, another one offering 900,000, and the last one is offering me 100,000. So let's look at it from a risk perspective. If today I put in 300,000 to buy over the bubble tea shop, and let's say unfortunately, you know, this COVID actually came suddenly nobody drink bubble tea. The government say, hey, you cannot even sell bubble tea because the bubble tea was spread virus. So because of that, I had to close down my whole business. So what is my maximum risk? You can see that my max risk is probably 300,000. All right. And if I had put in 900,000, my maximum risk is actually 900,000. And if I had only put in 100,000, my maximum risk in this particular case is going to be 100,000. So next, we have to look at the return as well. So when I put in 300,000 to invest and I can get back 150,000 every single year, what is my return on investment? It's going to be 50%. Okay. If I put 900,000 and I get 150,000, my average return per year is about 16%. And when I put 100,000 and I get back 150,000, you can see that my return is actually 150,000. All right. So even for Sriram, okay, he mentioned that he's going to put in 1.5 million. Does it sound like a really, really big number? We can see if you had put in 1.5 million, what is your return is going to be? Your return is going to be 10%. Okay, your return is going to be 10%. So some people might find that 10% is not a lot of money, but let's look at your bank interest rate. How much is the bank giving you every single year? 0.05%. So if today you put into an investment and every single year is able to grow by 10%, in fact, it is actually quite reasonable, quite a reasonable amount. Okay, coming from that point of view. And of course, we look at this. So if I look at a 300,000, the conclusion is I have moderate risk and I get moderate return. But when I put 900,000, I have the highest risk. But when you look at the return comparing these 3, I have the lowest return. And on the other hand, if I have only put in 100,000, I have the lowest risk. I'm taking the lowest risk. But my return out of these 3 is actually the highest. So can you see that from this particular example, I'm actually able to achieve this thing called low risk, high return. All right, if you can see that this is happening, just type, okay, yes, okay, just type yes, YES. If you can see the low risk, high return happening, just put in the yes, all right. Okay, so this is an illustration to actually share with you guys. But again, I just want to share, okay, why is it that in this particular scenario, it works like this? Okay, it doesn't happen everywhere, but in this particular scenario, you can actually achieve this thing called low risk, high return. It's because you see that the return that this business is giving me is a fixed amount. I'm talking about 150,000 is a standard amount. But what is the thing that can go up and down? What is the thing that is different from every individual? Is actually the takeover price, the takeover amount. Okay. So now we look at, we use this concept, we apply into the stock market today when I invest in this company, for example, McDonald's, okay, McDonald's is consistently making a fixed amount of profit. Okay, but you realize that what is changing for McDonald's is that the share price can go up, the share price can go down. So when I invest in McDonald's, when the share price is high, basically for the amount that I paid, my return is still the fixed amount. So my return is going to be lesser. But let's say in current market condition, okay, the stock market crash, okay, but you realize that people are still going to McDonald's. McDonald's are still going to be profitable. So which means that the profit is going to be consistent. But what happened to the share price? The share price probably have dropped 50%. Okay. Previously, it was selling at 1 million, but right now McDonald's is only selling at 500,000. But the profit is actually the same. Okay, no change to the profit. But what has changed is the price that you actually have to pay to own this particular asset or this particular investment. So that is why we say that, okay, you want to buy over a stock or you want to buy over a business at a very, very low price, as low as possible. Okay. So why is it so? Because people say that you want to buy low, sell high. Okay, that is the concept. You want to buy at a low price and you want to sell at a high price. Yes. But if you look at it from business perspective, when you buy at a very, very low price, your return is actually very, very high. Okay, because the return from the business is a fixed amount. It is a standard amount. It doesn't change, but the price change. So right now, when we look at the stock market, okay, I would say that many companies are somewhere in the 100,000 to 300,000 range. Okay, pretty much we are somewhere at the low risk and relatively high return. Okay, right now a lot of stock has dropped a lot, so we are looking at somewhere in the range of about 100 to 150,000 range. Okay, but what I want to share with you guys is we want to go to the market and we want to take over this bubble tea business at even less than 100,000. We only want to pay 50,000, or even just now somebody mentioned $1. I want to use $1 to buy over, you know, your business, which is giving me 150,000. Is that possible or not? Is that possible or not? Later, I will show you some real case study. Okay, it is highly possible. So we need to be patient. Okay, so number 7, how fast can I get back my investment? So this is what Warren Buffett mentioned. Price is what you pay, value is what you get. So what does this mean? Okay, what does this mean? So let me show you. So I'm going to ask you this question. Which company has more value to you? Okay, so this one I need everybody to also answer inside the chat group. So based on looking at this, looking at just the branding itself, okay, which one do you think has more value? Singtel or Sheng Siong? All right, interesting. So we can see that pretty much it's on par. But okay, next question, very, very important one. Next question. Okay. So now I give you the share price. Singtel is $2.47 and Sheng Siong is 106. So if you think Singtel is more valuable, just type ST. ST. If you think Sheng Siong is more valuable, type SS. But I will say 80% or 85% of you are saying that ST, Singtel, is more valuable after looking at the share price. Okay. Okay, so now coming back to the PowerPoint. So you can see that, okay, just now Warren Buffett mentioned price is what you pay, value is what you get. So when you look at just the price alone, we are looking at how much we are paying for Singtel. So on the stock market, Singtel is at 247. So we are going to pay 247. But does it mean that it has more value? Okay, it doesn't necessarily mean, okay, it has more value. So how do we know whether Singtel compared to Sheng Siong, which one has more value? So right now, I'm going to share with you, how do you evaluate a business? Okay, how do you evaluate a business? So we don't look at the share price, okay, but we actually have 3 methods to value a business. So that's coming up next. So before I move to valuation, you need to understand there's actually 3 types of business. Okay, I just classify them into 3 types of business. Number 1, the first type of business, asset-heavy business. So what do I mean by asset heavy? That means all these business, they actually have a lot of asset. And what are some definition of asset? We talk about cash. Okay, things that are valuable. Okay, of course, computer are not considered valuable. Okay, we're talking about cash. We're talking about real estate. So we can see over here, OCBC, DBS, Capital Land, Maple Tree Logistics. So they own property, they own land, they own cash. Okay, so all these are what we call asset heavy or rather cash-rich business. So the second type of business we are looking at is stable business with consistent dividend. So these companies are relatively stable, okay, and at the same time they are giving out dividend every single year. So some of the example I can give you are SETS, Singtel, SPH, as well as Ascendas REIT. So all these companies relatively stable. They are not going to grow 100%, but they are, you know, maybe growing at about 8 to 12% on a yearly basis, and they are constantly giving out dividend. So of course we have the last one, profitable business without consistent dividend. Okay, in short, okay, they are not really growing, but they are still making money. Okay, but the thing is, because they are not really growing, they are also not giving out a lot of dividend. So some company, maybe they are still growing. Like for example, Sheng Siong. Okay, they have expanded a lot over the last few years. So that is why when you look at the dividend, it might not be as consistent yet. Okay, it might not be as consistent yet. So these are the three, I would say I classify them into these three, like asset heavy, okay, company that give consistent dividend, and company that don't give consistent dividend. Okay, just remember these three. So what happened is that today, if I find a company that is profitable without consistent dividend, okay, I'm going to use this formula to calculate the value. So this formula is what we call the PE ratio. Okay, PE ratio. You can see it's actually price to earnings ratio. Okay, price to earnings ratio. So if you forget what is the formula, just remember it is price over earnings. So what is price? Basically, we are talking about the share price. Okay, the market price of the share. What is the earnings? Earnings is basically what I've just shared with you just now. The earnings per share. Okay, the PE ratio. So let me ask you this very important question next. The bigger the PE, better, or the smaller the PE, better? Okay, just type into the chat group, bigger, better, or smaller, better. So you just type big or small. Okay, small. So far, everybody type small. Okay, so think of it this way. Today, you put 10,000 with your friend to invest in something. How fast do you want to get back your money? Do you want to get back in 1 year, 2 years, 5 years, or 10 years? Okay, so PE is basically telling you how fast does it take for you to recover back all your investment. So in this particular example, when I have a PE 2, it also tells you that my return on investment every single year is 50%. Okay, 50%. So 50% for 2 years, I get back my money. So that's 100% back. Okay, so coming back to this slide. Okay, so that is for the PE. So PE, the lower the better, the smaller the better. So now when we come to asset-heavy business, okay, asset-heavy business, we are going to use this thing called a price to book, okay, value formula, okay, price to book. So again, when I say price to book, you just take the market price divided by the book value per share. So what is book value per share? Book value per share basically is telling you what is the net worth of this business. Okay, what is the net worth of this business? So let me just give you an illustration. For example, today, okay, I just take out something from my wallet. Okay, so if I show you this piece of paper, can somebody tell me what is the net worth of this piece of paper? How much do you think this paper is worth? Just type into the chat group. How much is this piece of paper worth? Okay, $50, right? Okay, so everybody type $50. Perfect. So if today I'm going to sell you this piece of paper, okay, how much are you willing to actually pay for this piece of paper? How much are you willing to pay for this piece of paper? For example, today, if I go to OCBC, right, I sell away everything in OCBC, okay, because OCBC is a lot of cash, so I take all the cash, I sell away all the buildings, all the asset that OCBC have. Let's assume that it's going to be 100 billion. Okay, OCBC is actually valued at 100 billion, the net worth of OCBC. So if today I want to invest in OCBC, I want to make sure that I pay less than 100 billion, which means that even if, let's say today, OCBC suddenly go bankrupt, okay, the net worth is still there, the cash is still there, the cash is still worth 100 billion. Okay, so even if they are not making money, technically the cash is still cash. So when we talk about net worth, we have to take the asset minus the liability. So minus everything off, they are still worth 100 billion. But what I want to do is I want to buy 20% below 100 billion. So if today OCBC is worth 100 billion, I'm only willing to pay 80 billion and lower. Okay, 80 billion and lower. I want to buy them at a 20% discount, which means that if you look at my $50 note, I'm only going to spend $40 or less. So if today this $50 note is offered to me at $35, okay, I'm willing to pay $35 for it. Okay, so same thing. When you look at the stock market, okay, the net worth of the business doesn't change a lot. Okay, the net worth of the business doesn't change a lot, but the price constantly go up and down, up and down. So when one day the price of this asset goes below the book value by 20%, okay, that is the time whereby you want to go in and grab the asset, because you know that you are very, very safe. Even if shit happens, okay, you are still getting them at a 20% discount. So that is why we only want to use this particular formula for companies that have a lot of asset. Okay, companies that have a lot of asset. When I talk about asset, we are talking about, of course, cash, property, or anything that has value, and anything that has value. So computer, laptop, all that, okay, no value. You buy at 2,000, when you sell, probably it's going to be worth less than $1,000, right? So the last one is when you're looking at a stable business with consistent dividend. Okay, when I'm looking at a business that has consistent dividend, I basically invest in this business just to collect dividend. So what is important to me is the dividend yield. Okay, it's the dividend yield. Just think of the dividend yield as your bank yield. Basically, if you want to invest in a bank that give you the return that you're looking at. So how do you calculate this dividend yield? You calculate from the dividend per share. So every year the company is going to distribute, or they are going to declare the dividend, how much dividend they are going to distribute per share. You divide it by the share price. That you get a percentage. Okay, that you get a percentage. So for example, today I pay $10, okay, to own, let's say, Sheng Siong. I pay $10. So at the bottom, the price per share is $10. And every year, I get back 40 cents, okay? Sorry, 40 cents. So 40 cents divided by $10, that will give you a percentage of 4%. Okay, 4%. So I buy Sheng Siong at $10, and every year, Sheng Siong will distribute 40 cents back to me. So my dividend yield is 4%. So when we look at dividend yield, how much is good? Okay, how much is good? Basically, anything that is above 5% is good. So we want to invest in the company when the dividend yield is more than 5%. Okay, the dividend yield is more than 5%. So again, just now I mentioned the dividend that is declared every single year is pretty stagnant. So usually companies don't increase or decrease the dividend a lot. They will just keep it stable. But what is changing every single day is the share price. So for example, today Sheng Siong is $10. So the dividend yield is 4%. So we are not going to invest in Sheng Siong. But what happened next is, what if Sheng Siong share price drop from $10 to $5? So the dividend is going to be the same. It's still going to be 40 cents, but now 40 cents divided by $5. Okay, and what would that give me? That would give me a 8% dividend yield. So when I see Sheng Siong at $5 giving me 8% dividend yield, I will buy them. Wow, I have special effect. Okay, 5%. Okay, I will actually go and buy them. Cool. So that is important. So when you invest in a company, okay, a company that gives consistent dividend, make sure that they are giving you more than 5%. And why am I so excited? Because right now in Singapore, many of our local banks, okay, we don't have many, basically we are looking at OCBC, DBS, and UOB. 3 of them, they are all giving more than 5% right now. Okay, the 3 banks are giving you more than 5%, which means that you know that today when you invest in a bank right now, you are going to consistently get a 5% dividend yield. Okay, consistently 5%. So if you put in 10,000, that is $500 every single year. Okay, if you put 100,000, that's 5,000. Cool. Let me continue. So now, okay, coming back to the PE ratio. So just now I mentioned we don't look at the share price, okay, we look at the valuation. So now comparing Singtel and StarHub, okay, now you all tell me which one is more valuable. Okay, now moving on to the next question. So now I give you another one. So now I have these three. Okay, OCBC, DBS, and UOB. So when we look at banks, we look at the price to book. So price to book, we want to go that as low as possible. Okay, as low as possible. And remember my 20% discount. Okay, 20% discount means I want to buy at price to book 0.8 and less. Okay, so less than 0.8. So out of these three, which one can I invest right now based on price to book? Okay, so everybody mentioned OCBC. Okay, fantastic. So we want to buy OCBC because the price to book is less than 0.8. Okay, because the price to book is less than 0.8. Fantastic. Okay, so now coming back to the last one, which is dividend yield. So this dividend yield I actually extracted just this afternoon. So Capital Mall Trust is giving you 6.44, Mapletree 5.17, and Ascenders REIT 5.6%. Okay, so let's just compare these three. Okay, looking at these three, which one would you actually prefer to go in? Capital Mall, Capital Mall. Okay, cool. So far, I see everybody is typing the same one, which is Capital Mall. Okay, if just by looking at these three, Capital Mall Trust, okay, seems like a better deal. But again, it doesn't mean that Capital Mall is better or what. But we are just looking at the valuation. Okay, for the same amount of money that I put in, Capital Mall is able to give me a better returns. Okay, 6.44. So that is what we are looking at. So another thing to take note, okay. So just now I mentioned that dividend yield, we want to look at minimum 5%. But in Singapore, we have this thing called Real Estate Investment Trust, REIT. Okay, so Singaporeans love to buy REIT because they give relatively higher dividends. So when it comes to valuation, when it comes to valuating a REIT, we want to make sure that if you're investing in a REIT, minimum is 7%. Okay, I repeat, minimum 7%. So if you're investing in a REIT, okay, the valuation is a little bit stricter. We want to be collecting at least 7%. So which means that even in this particular case, Capital Mall, Mapletree, and Ascenders REIT, all right, none of them fulfill my criteria at the current moment. So what I'm going to do is I'm going to wait for the price to drop even lower. Because when the price drop, what happened to the dividend yield? The dividend yield will increase. All right. EC World REIT. Okay, so that one you can go and check. Okay, that is your home on. So 13% dividend. So again, this one you have to go and check. Okay, sometimes when things are too good to be true, they probably are too good to be true. Maybe, you know, it's a bit unstable. Okay, usually you can see even comparing these three, they are relatively about the same, 5-6%. All right, but when you see something that is 13%, it could mean that the price has dropped a lot. Okay, the price has dropped a lot. So recently we saw that there's actually a REIT that is it has trouble, it has trouble, and the banks are actually asking them for money. So again, we want to avoid those kind of unstable stock. Okay, we are looking at something that is stable, so that you can sleep at night. Okay, if you cannot sleep at night, then don't invest in that particular stock. So when it comes to Singapore, we have this thing called the Straits Time Index. So people always say the STI. It actually means for Straits Time Index. Basically, STI is the benchmark for Singapore stock market, and it tracks the top 30 companies listed on the Singapore Exchange. So which are all the 30 companies you can see over here? Okay, they are the DBS, Hong Kong Land, UOB, UOL, SPH, Mapletree, CapitaLand, Ascenders, Mapletree, Singapore Exchange, CapitaLand, SETS. So pretty much I would say that 80 to 90% of the company, you guys should be familiar with it, or at least you have heard or seen them before somewhere. All right. So again, how they get this 30, usually they will find companies that are relatively stable and strong, okay, to put it as the component of this Straits Time Index. So some people, they say that this is like the blue chip, okay, the blue chip. So relatively safer. So what we're going to do is today, because the Singapore Stock Exchange has dropped so much, so instead of looking at so many companies, Singapore has a lot of companies, we are just going to focus on just these 30 STI. Okay, normal days, when you invest in them, they are always very expensive. But in current situation, many of them are at a massive discount. When I say discount, I'm looking at 40 to 50% discount. Okay, many of them are already at a 40 to 50% discount. So it brings to my attention again, because why? All these companies are relatively stable and safer. You buy them, you can sleep at night, and the valuation right now is attractive. So they are somewhere around 100 to 150,000 for the bubble tea shop example. All right. So later I'll share with you, okay, how do we get them at 50,000, even lower? Okay, later I'll share more. But pretty much now it's very, very attractive. Okay, so I'm moving on. Okay, so again, I've been talking for, let's see how long. I've been talking about an hour. Okay, so I still have about 1 hour to share with you guys. So again, I just want to make sure that you guys are still here. Okay, so I have a special gift for you lah. But in order for you all to receive this gift, right, you all need to stay all the way until the end. Okay, so let me just continue. Okay, so what is this gift? Okay, I'm going to give you the full list of 30 companies with all the fundamental and valuation done. So remember my STI 30. I have the full list of the STI 30 with the fundamental, which is the earnings per share, the cash flow, the debt, okay, and the valuation, everything done. And I'm going to give it to you for free. Okay, and not only that, I have a Telegram channel where I share with you exactly what stock I'm looking at and what other strategies that I'm doing for this recession. So this is literally, you are inside my brain. I'll tell you everything that is inside my brain. So again, I will invite you guys into my Telegram channel, but that is if you stay all the way until the end. If you stay all the way until the end. Some of you, I know in this group, you are already inside. Okay, so the reason for me for also doing this session is so that you understand, okay, how the list is being read. If not, I give you the list, but you don't know exactly what I'm talking about. It doesn't fulfill anything. Okay, so this video tonight is also to make sure that those who are already inside, you know how to read the 30 stocks that I actually shared with you guys. Okay, so what's next? Okay, so you have already learned what is a good business and when is a good price. So this one I have already shared with you. Okay, so now coming back to the main key topic, okay, for tonight. How can we take advantage of the bear market? Okay, how can we take advantage of the bear market? So this is something that is very, very interesting. So a lot of people say, Bowen, how do you know that it's a bear market and what exactly is a bear market? Okay, so in short, okay, in the investing world, there's two kinds of market. One is the bull market, one is the bear market. So when the stock market is going up, it's called a bull market. It's like a bull, okay, going higher and higher. Okay, but the bear is basically telling you that the stock market is coming down. It's coming down. So if you look at this particular chart that I have actually put in from 2008, okay, in fact 2009, early 2009, all the way to 2020, the market has been going higher and higher and higher and higher and higher. Okay, like crazy, like a crazy bull. Okay, but what happened right now? You can see on the picture, the bull has collapsed. Okay, the bull has collapsed. So now the bear has taken over. Okay, the bear has taken over. So next question people ask, so Bowen, are you sure that we are in a bear market? Okay, and what defines a bear market? So this is not I say one, this is what I get from the internet, from Google. So a correction, usually people say that there's a market correction. So market correction means that the stock market has dropped 10% from a recent high. So a 10% drop is called a correction. A bear market is a decline of 20% from a recent high. So if it dropped 20%, it is called a bear market. Okay, so let's take a look. You can see from this particular chart, right now, the stock market from the highest point, it has dropped 27%. So can you all tell me what kind of market are we in right now? Okay, what kind of market? Is it a correction or is it a bear market? So some people also call it a recession. Okay, some people also call it a recession. When there's a 20% drop, it's called a recession. Okay, but for me, a recession actually is a package lah. So recession is like a bundle. Okay, it consists of the bear market. It consists of unemployment rate increasing. It consists of the government pumping in a lot of money. People are not spending. That package together is called recession. Okay, so right now we are at the start of a bear market and also at the start of a recession. Okay, at the start of a recession. Somebody say cat, huh? Yes, so we are down 27% over the last about 3 weeks to 1 month. Okay, the stock market has fallen 27%. So this is also why we are actually doing this, is because people always say that during times like this is the transfer of wealth from the rich to the poor. Okay, why is it so? It's because, remember, if let's say today you are the CEO of Facebook, okay, so Facebook share has dropped 30 to 40%. Technically, your net worth has also dropped 30 to 40%. Okay, so right now, if you go and Google Warren Buffett, his net worth is no longer 70 over billion. Probably we are looking at a range of 60 over billion. Okay, so he has lost 10 over billion in paper loss. Okay, his value, his net worth has fallen by 10 over billion. So where does this money go? So this money must go somewhere, correct? So some people say that during this kind of crisis, it is the transfer of wealth from the rich to the poor. Okay, but again, for me, I have my understanding. I don't totally agree with this, okay, transferring of wealth from the rich to the poor, but rather I would say that this is a transfer of wealth from the rich to the educated. Okay, from the rich to the educated. Okay, why do I say that? Because people who are poor, people who are not doing anything, people who are complaining about the recession, about them being jobless, and they are not doing anything about it, basically, are they going to become rich overnight because of the recession? The answer is no. In fact, they are probably going to be worse off. So there are many people from the middle income, they drop to become lower income. Okay, because to them, they have lost their job. They have lost their opportunity. They have money in the stock market and they are currently at a loss. They are losing money. So again, like I said, this kind of opportunity is a transfer of wealth from the rich to the educated. So if you are educated, you know what to do in this kind of opportunity. That is where you will be able to capture and acquire massive amount of wealth. Okay, so moving on. Okay, so I just want to share with you what do I mean by this. Okay, so this is actually a case, a real testimonial from one of my students. Okay, he actually turned $400 into $20,000. Okay, by buying into this company called Borwen. Okay, so you can see that his return was about 8,000 over percent, and this all happened within a span of about 2 months. Okay, within a span of about 2 months. So within 2 months, he made 8,000%. All right. So he has already seen how powerful or the possibility of acquiring massive wealth during this period of time. Right. So later on, okay, I'm going to share with you how you guys can also achieve this kind of returns. Okay, if you want to know how to get 8,000%, okay, just type in the chat group, I want 8,000%. Okay, type in the chat group, I want 8,000%, and then I'll share with you exactly how to achieve this kind of return in this current situation as well. If you want more than 8,000%, you just put 80,000%. More than 8,000%. Okay, fantastic, fantastic. Wow. Awesome, awesome, awesome. Okay. All right, so let's get started. Let's get started. Okay, I'm getting more excited after looking at all your comments. All right. So basically, how do you actually build this massive amount of wealth? Okay, I'm going to share with you exactly what I do, okay, in this company that I actually co-founded, Ultimate Investing. So this is our blueprint. Okay, so step number one, you must have a shopping list. Okay, you must have a shopping list. So you must know exactly what to buy in this current market situation. And the second thing you want to look at is look at the trend. Okay, look at the trend. Step number three, you need to execute with option strategy. Okay, so this is the 3-step: creating a shopping list, look at the trend, execute with option strategy. So let's start with the first one. Okay, step number one. So how do you create a shopping list? Basically, you want to have a list of companies that fulfill this criteria. Okay, what are some of the business that will be heavily affected during this COVID crisis? Okay, remember the key topic of this is how do we profit from a bear market? So we know that the stock is coming down. Okay, so we look at the whole crisis. Okay, what are some of the business that are heavily affected during this COVID crisis? So I will share with you some examples. Okay, in fact, many of the ideas actually, you can get a lot of ideas just by reading the news, just by subscribing to all the different news channels. So for example, you see SIA expected to seek external funding. Okay, so full year 2021 could see a 1.3 billion loss, okay, as COVID-19 kills off air travel. So if you look at the history of SIA, although they are not a fantastic business, but they are profitable every single year. They are making money every single year. But based on this, next year they are expected to lose $1.3 billion. That is a lot of money. Okay, and of course, when all the airlines are stopping, who is going to be affected? Okay, the people who are manufacturing the airplanes. So Boeing, okay, so you can see over here, 59 Boeing 737 MAX orders were cancelled in February as well. So the total potential loss is again in billions. Okay, so they actually lost billions in contract. So Boeing is also highly affected. Next, we look at this. Iconic hotels in Victoria shut down over coronavirus concerns. Nowadays, who is still staying in hotel other than people who are quarantined? I know that Singapore, basically if you go to MBS, you find a lot of Malaysian because the government is actually allowing some of the Malaysian who are stuck in Singapore to stay in some of the hotels over here. Okay, other than that, I think those people who just came back from overseas, they are immediately quarantined in hotel as well. So right now, the hotels, basically, you don't see any tourists. Literally, I would say that less than 1%. Okay, only people who actually stay here do want to go back. But pretty much, you don't see any tourists coming into Singapore anymore. So nobody is staying in hotel. All right. And of course, we look at the cruise. Okay, cruise are highly affected because they are a good place to spread virus. We know what happened, to the cruise, over in Japan. So many people are affected because they were inside the cruise and everybody is quarantined. So again, now if I give you money, right, to go to the cruise, right, probably you also not go. Okay, even if I pay you $1,000 to sit on the biggest cruise, you will probably pay me $2,000 or so to not sit on the cruise. Okay, so two of the world's biggest cruise line extend shutdown into May. So massive damage done to the cruise industry. Okay, and of course, we talk about something that we all love, food. Okay, if you go to US, this is a place you must go, Cheesecake Factory. Okay, even for Cheesecake Factory nowadays, F&B, they are highly affected. So Cheesecake Factory tells landlord across the country, it won't be able to pay rent on April 1st. Okay, so they are actually closing a lot of the dining rooms. Okay, and they are also in a huge loss that they are not going to pay rent. All right, so that is how bad they are being affected as well. So Cheesecake Factory, and again, Cheesecake Factory and all the companies that I just mentioned above, they are all listed in the stock exchange. Okay, they are all listed in the stock exchange. Most of them, they are listed in US. Okay, and of course, SIA is listed in Singapore. So let me just use these four as an example. So in our watch list, we have Boeing, Cheesecake Factory, Royal Caribbean, and of course, hotels. I'm going to use Las Vegas Sands as an example. Okay, so these are the four that I say that will be highly affected. So now coming to number 2. So now in my watch list, I have four companies in my watch list. So look at the trend. Okay, what are we looking at? Like I said over here, never go against the trend. So first, let's take a look. If we look at this particular chart, so on the top left-hand side, they have this word called SPDR S&P 500. So basically, this chart is a representative of the 500 largest company in US. So this is the US index. Basically, it's telling you overall, in terms of the US, how is it performing. So we can see that US index has dropped a lot as well. Okay. So one thing we want to look at when it comes to trend is, I want you guys to look at these two lines, the green line and the red line. Okay, the green line and the red line. So this green line and red line is what we call the moving average. Okay, moving average. Okay, so this is the 50 moving average as well as the 200 moving average. So the green is 50, the red one is 200. But basically what we want to point to you is, you can see that when the thing is going up, when the stock market is going up, the line will follow. Okay, the line will follow. So that is a nice trend. What happened when the line crosses? You can see that towards the end, the green actually cuts the red line. Okay, the green cuts the red line. So there's actually a term for it. Okay, so when the green line cuts the red line, this is what we call a death cross. Okay, a death cross. So from the name itself, we know that it is something that is pretty serious lah. Okay, from the name itself, we know that it's telling you that death is coming. So which means that everything is going down. Everything is going down. Okay. So what do we do when we see this? Okay, what do we do when we see this? So basically, if you previously have whole stocks, previously if you are owning stocks for the last few years, when you see this, you need to sell away everything that you own. Okay, you need to sell away everything that you own. Okay, because it's telling you that the price of your stock is going to go down massively. So if previously you are investing in the stock market, when you see this cross, okay, you must sell away everything. So it happened, I think the cross happened a few days back, about four days back. So technically you should sell away everything about 3 or 4 days back. Okay, moving on. So again, right now, okay, how are we able to benefit from the bear market? Which means that when I see this, I also know that the stock market is going to go down. Okay, so how can we actually take advantage? So later on, I'm going to share with you how you can use option to actually make money when the share price go down. Okay, I'm going to share with you later on. So right now, I'm going to share with you using Cheesecake Factory. So just now we were looking at the overall US index, okay, the overall US as a whole. So now I focus back to the 4 companies that we have. So one of them is Cheesecake Factory. So you can see that actually back in 2018, in fact 2018 November, this company has already been performing. That means the cross has already happened. Can you all see over at the red color circuit area? The cross actually happened not recently because of the crisis, but back in 2018 November, the share price of this company has already started dropping, and you can see the cross. So again, like I said, if you see the cross, what you can do is, if you previously owned the stock, you need to sell it away. If you want to take advantage of this, what you can do is you can actually use option and bet that the price will go down. If it goes down, you make money. So in the case of this example, you can see that from $48 after the cross, it constantly goes down. It doesn't go down in one direction, but it actually go up, down, up, down, up, down. But you can see that it is going lower and lower and lower. And of course, because of the crisis, okay, from about $40, it dropped all the way right now to about 18.87. Okay, that's a massive drop. Okay, massive drop. So next, we look at this company called Las Vegas Sands. Okay, so same thing. Okay, very recently, it has a major drop and the cross happened. Okay, the cross has happened a few days back. So if you are currently holding this company, okay, please be careful. Okay, please be careful. Unless you are betting that it will go down. Okay, if you're betting that Las Vegas will actually go up, please be very, very careful, because the death cross has happened. So this is the next thing that people always ask. Okay, people always ask me, Bowen, okay, I look at this, I saw the cross, but this company used to be $70 over. You can see it's about $75. Right now, it has dropped to about $47. I thought you say that when the price drop is a good time to actually buy. Okay. So now I want to ask you guys, okay, looking at Las Vegas Sands, it used to be $75. Right now it's $47. Do you think this is a good time to buy? If you think this is a good time to buy, just put buy. If you think it will drop further, just put sell. Okay, if you think it will go up, just put buy. If you think it will go down further, just put sell. Okay, so let's put into the chat group. All right, so later on I'll answer some of your questions. Like Yao King mentioned, will Cheesecake Factory go bankrupt? It's possible. But again, we need to look at the cash flow of the business. Do they actually have the cash? If this company has a lot of debt, then coupled with this crisis coming, I would say that there is a possibility that this company can go bankrupt. All right. But of course, if the company has been growing and not leveraging, so they have very, very low debt, then they might be able to actually ride through this crisis. So it actually depends a lot on the debt to equity. So that is the part whereby we need to go and check for all this company. Okay, so next, okay, let me see some of your reply. JJ, how long after the cross it will happen? How do you gauge? Basically, when the 50 cross 200, right, it doesn't mean that immediately the price will drop. Okay, but later I will share with you more case study on after the cross, how the thing is going to move. All right. So later I have more examples. So pretty much, I think most of you say sell, sell, sell. So quite okay, quite okay. You guys so far are doing very, very well. Why did it go up when casino are not frequented the past few weeks? Okay, again, back to Julian. Okay, the price go up and down is based on people buying and sell. So a lot of people buy and sell not because of the business. They didn't even look at the real business. They buy and sell simply by looking at the price. Okay, a lot of people buy simply by looking at the share price. So again, like people for us as an investor or people with value investor mindset, we always look at the business. So if you look at casino, exactly, people are not going to the casino. Okay, and yeah, basically we know that very likely all these companies are going to lose a lot of money, at least for this year or next year. So they are basically in a deep trouble. So later I'm going to share with you more about Las Vegas as a example. So now the key thing is from $70 over drop to $47, already dropped so much, can drop further. For those of you who are inside the Telegram channel, I already shared this example, okay? Back in 2008, okay, during the last crisis, okay, the financial crisis, Las Vegas Sands from $150, it actually dropped within 1 year, over 12 months, it dropped from $150 to $1.96. All right, so that is a 98% drop. In fact, more than 98%. Okay, Las Vegas Sands dropped from $150 all the way to $1.96. Okay, so back to you, JJ. So just now I mentioned, you can see the same thing happen. Okay, when the 50 cuts 200, okay, so sometimes there will be a rebound. So what happened is that as an investor, when I see the cross, so I expect the price to go down, right? Okay, but then what happened to the share price? The share price actually go up. Then I say, hey, am I wrong or not? Am I doing the wrong thing? You know, so sometimes our emotion will actually waver. So what I do is sometimes it is good when you see the signal, you buy and then you don't look at it. Okay, you can see what happened. Okay, market will go up and down, but over the long run, it actually go all the way down. Okay, all the way until $1.96. So if you ask me right now, Las Vegas Sands at $40 over, okay, maybe I just throw this question to you, at $40 over, do you think this is cheap or expensive? Looking at what is happening right now in the current market situation, is it cheap or expensive based on the current price of $40 over? Just put into the chat group. If you think $40 over is cheap, then you can buy. And if you think it is expensive, means we are expecting it to drop even more. Okay, let me take a break. Right, so if you ask me, right, I feel that at $40 over, it is super expensive. Okay, super expensive. I won't even not consider buying it at any. I would even have a thought Okay, no way I'll buy it. So now coming back to the overall market index. So we look at what happened in year 2000. You can see that the SPDR, which is the US index, okay, it has also fallen a lot. And most importantly, can you all see the golden cross? Can you all see the 50 cuts 200? So it happened, okay, back in year 2000, which is the dot-com bubble. So imagine when you see the cross, you actually get out of the market. Can you see that actually save you by a huge margin? You will probably not be hit like many of the other people. So when you see the cross happening, it is a very, very strong signal to tell you to get out of the stock market. Okay, and of course, for people like us who knows how to short the market, okay, betting that the stock market will go down, when we see this, what can we do? What can we do when you see the 50 cross 200 back in year 2000? We are going to start shorting the market. And can you see from the cross happen all the way down, how much money will you make? You're going to make a lot of money. Okay, so if you had this knowledge back in year 2000, you are going to make a lot of money. So again, is this a one-time thing? Okay, let's take a look at year 2007, which is the last financial crisis. Same thing happened, 50 cuts to 100, okay, and then the stock market started to go down, okay. So if you had started shorting the stock, betting that the market will go down after you see the cross, okay, can you see how much money you would have made, okay, by doing that? Okay, and again, for people who already been investing, it can actually save your life. It can actually save, I mean, literally your portfolio, because you actually get out at the right timing. It might not be the best timing. We are not getting out at the peak of the share price, but we will be able to avoid, you know, holding it and then letting the price go all the way to the bottom. So just this one thing alone is able to help you, okay, a lot. Let me look at some of the things. Okay, what is EMA and why do we or should we use 50 and 200 as an indicator? So EMA is exponential moving average. It is basically an indicator. Okay, it is an indicator. So why 50 or 200? Okay, very simply put, okay, all the big players are looking at it. When I talk about the big players, I'm talking about the hedge fund. I'm looking about the financial institute, the big banks and everything. So all these big traders, they are all using 50 and 200. So what happened is that, right, okay, this is a bit of a, I would say, self-fulfilling prophecy. So for people like me, when I see 50 cuts 200, what I'm going to do is I'm going to short the market. Okay, so same thing happens to all the big hedge fund and all the big traders. When they see 50 cuts 200, they are also going to short the market. So then what is going to happen? The share price is definitely going to go down a lot. So again, when we say right with the trend, we want to follow what the big players are doing. Okay, and we do exactly what they are doing. So that's exactly what we are doing over here. All right, so coming back to right now, okay, in year 2020, okay, so coming back to, we can see that right now the stock has dropped about 27%. So a lot of people is telling me, borwen, I think we have already hit the bottom. Okay, it seems that right now the price is coming back up. All right, so I just want to reference back to the last two crises again. Let's take a look on average, right? How much has the market dropped for the last two crises? So back in 2007, the US index has dropped 57%. Back in year 2000, the index has also dropped 50%. From the top all the way to the bottom, that's a 50% drop. So right now, coming back to year 2020, okay, right now we have already fallen 27%. So in my personal opinion, I believe that the market will always repeat itself. So a 50% drop is expected. Okay, but again, I have to back it with something that is more realistic. Okay, so why I find that 50% in this current situation, it is highly possible, is because right now what we are facing is not a financial crisis. Okay, some of you might have already heard this phrase before. We are not in a financial crisis. What we are facing right now, it is a health crisis. Okay, so in year 2007, what caused the bubble to burst is because of the subprime mortgage. It's because of the banks. So the banks are affected. Back in year 2000, what is affected is basically the tech company, the dot-com bubble. All the internet companies are affected. But right now, we are at the health crisis. Which are the businesses that are actually being affected right now? You can see that many industries are being affected right now, including hotels, including airlines, including retail, okay, and many more. So the impact of this crisis, I would say that it is even worse than 2007, okay? And of course, we know that right now, we still do not have a cure to it. So how long will this go on? Nobody knows. If let's say for the next 3 to 6 months, this thing continue, can you imagine, okay, based on the current rate of escalation, what is going to be the death rate? What is going to be the number of people who are going to be affected? Okay, so all these are question mark. And subsequently after, even if we have a cure, for the business to recover, can you imagine how long it takes for the business to actually start to recover? Okay, so this is actually something that is really serious. And I'll say that this COVID crisis is way more serious than 2007, way more serious than year 2000 dot-com bubble. So a 50% drop to me, it is the minimum. Okay, a 50% drop to me is a minimum. All right. So at 27%, my personal take is that I believe that it will continue to drop more. But short-term wise, there could be a rebound. Okay, like I said, it always happens. The market don't go down in one direction. It actually goes down, okay, recover, goes down even more, recover, goes down even more. So it actually goes down in a certain pattern. Right, so coming back to the last part, okay, which is step number 3, okay, execute with option strategy. Okay, execute with option strategy. Yeah, let me just make sure that the chat group. Okay, so Alvin has asked a very, very good question. So how do you actually short, okay, the market? Okay, so that is what I'm going to share with you right now. How do you actually short the market? So step number 1, right company. So remember, we need to have our watch list. Number 2, so right now the trend is going down. 50 cuts 200, the trend is going down. So we do not want to go against the trend. Okay, we do not want to go against the trend. So the last one is using the right strategy in current market situation. Okay, so what is option? Okay, I just want to share a little bit about option. Okay, so for me, I started option about 4 years ago, and I actually regretted not knowing much earlier. Okay, because why? I have friends whom I know about 4 years ago, they started option earlier than me. Okay, and what actually got me to learn option is because there's one, I remember there's one particular scenario, right? I bought into this company called Starbucks. Okay, and I actually make money. I was making about, I think maybe about 20%, okay, buying Starbucks, okay, betting that it will go up. So my friend also bought the same company, also bought Starbucks, but he uses option to buy it. Okay, and he told me that his return was more than 100%. Okay, his return is more than 100%. So I'm like, hey, how come we are looking at the same company? We use our value investing method. We buy at the same price, but I'm making 20%, but he's making more than 100%. And then that is where he shared with me that he's actually using this thing called options. Okay, so options allow him to generate a higher returns. So the next thing I will ask also, well, if you are generating higher returns, are you taking more risk? Are you taking more risk or not? Because high risk, high return. Okay, and then he actually tell me that no, actually his risk or the amount that he's actually putting or risking is actually less than me. So he's risking less and he's making more. So again, it comes back to my favorite, which is low risk, high return. So I realized that option also allow me to generate this kind of a low risk, high return trading strategy. Okay, so when I delve into option, I have never looked back, and I've actually regretted not knowing this much earlier. So of course, later I will share more about it. Okay, Yao King, how to volatility is so high, buying option is not a good choice. Later I'll share more about that. That's a bit more technical. Okay, so options are financial instruments that are derivative based on the value or underlying securities such as stock. Okay, so in short, in simple terms, option is basically just a piece of paper. Okay, so it is based on something underlying. In this particular scenario, it is a stock. So is that option used in other instrument or other asset? The answer is yes. So option is also used in the property market. Okay, so to give you an illustration, today when you go to a new launch, you sign for your favorite condominium, you sign the piece of paper, you realize that the piece of paper at the top it is written as OTP. So OTP stands for option to purchase. Okay, so that is actually also an option. So when you sign that piece of paper, technically that piece of paper will give you the right to own the real asset, which is your condominium. So same concept over here. Today when we sign that piece of paper for the option in the stock market, we don't have to pay the full amount. Instead of paying the 1 million, we probably have to pay about 5% or 10% of the original full amount. So I use less capital. So similar concept over here. So let me share with you. So advantage of option, okay, and why option gives you an unfair advantage. Okay, so first, option allow me to invest in 3 directions, up, down, and sideways. Okay, so today, if I believe that the market is going down, I can use option to bet that it will go down. And if it goes down, I make money. Okay, if it goes sideways, I can also use option to benefit from it. So I can invest in 3 directions. The second benefit, okay, the second advantage is option allow me to use lower capital. Okay, allows me to use lower capital. When I say low, how low is low? You can start with $100, $200. Okay, that is roughly the amount that we are looking at lah. You can start with $100, $200. When we look at the return, okay, so option also allow you to generate potentially higher percentage returns. Okay, potentially higher percentage returns. So in short, there are two kinds of option. Just remember there's two kinds of option. One is called call option. The other one is called put option. So how do you know what to buy? Okay, so we are always buying option over here. So if you believe that the share price will go up, okay, if you believe the share price will go up, you buy a call option. If you believe that the share price will go down, then you go and do a put option. So over here, you just need to take a photo and then just remember the color. Okay, green color means that it will go up, so you buy call. Red color means that it will go down, then you buy a put option. As simple as that. Okay, so it's as simple as buying stock lah. Instead, you believe it will go up, you buy call. You believe it will go down, you buy put. So now in the call option, okay, which like I said, is just a piece of paper. Okay, what is inside this piece of paper? There's actually 4 important information. Number 1, you need to have the stock name. Okay, so for example, today I want to buy Starbucks. So I'm buying the Starbucks option, so I need to put in Starbucks over here. Price to buy. So I also need to indicate what is the price, the share price that I want to buy Starbucks at. So same thing, the share price must be written over there as well. Okay, next, the number of contract. Okay, so in the option world, every contract, every piece of paper, okay, represent 100 share. Okay, I repeat. Okay, in the option world, every contract represent 100 share. So if let's say today I buy a call option, I buy 1 contract of Starbucks. So literally, I am trying to buy 100 share of Starbucks at a particular price, which is the price to buy. Next, okay, very important. Option is just a piece of paper, so it doesn't last forever. So there is an expiry date. Okay, there is an expiry date. So just remember these 4 things inside the option contract, then you will be good to go. Okay, so case study number 1. So for example, okay, we look at the past, Walt Disney. So for example, right now, right, let's look at the opposite scenario. When my green cuts the red line going up, it's actually telling me that this is a bullish signal. That means it's telling me that the Disney is going to go up. Okay, when my green cuts up the red line. The other example I give you just now is green cut down. Green cut down the red means it's going down. But now it's the opposite. Green cutting up the red line. So it's telling me that Disney is going to go up. So if I had bought Disney right back in, this is back in July 2018. Okay, the share price at the point of time for Disney was 110. And the option price, as you can see in the other circle, was $12.90. So it's cheaper. Okay, so I give you 2 examples over here. On the left hand side is buying share. On the right hand side is buying the option. So left hand side, I buy 110.20. This is the share price. I buy 100 Disney share. So how much do I need to come out with? Is actually the share price multiplied by the number of share, which is 11,000. On the other hand, if I buy a Disney option at 110, this is the price that I want to buy. The expiry date is 17 January 2020. 1 contract, because 1 contract represents 100 share. I only need to pay $12.90. So $12.90 multiplied by 100 is 12,1290. So if you compare these two, okay, buying the option actually uses lower capital outlay. Okay, lower capital outlay. So now moving on. Okay, so let's say about 1 year later, okay, 1.5 years later, 2020, the share price of Disney has already went up. So now it goes up to $144. So if you look at the option, okay, you can see it has went up also to $34.40. So now coming back to the same example, if I look at the share price, let's focus on the share price. So now the share price is 144. So previously it was at 110. So 110 goes up to 144. Actually, I make about 30% in return. Okay. So yeah, 110 become 144. So that's a 30% increase. But if you look at my option, right, from $12, it now went up to $34. So when you calculate based on ROI, it actually gives me 166% returns. Okay, so my $1,200 actually grew to become $3,440. So that is again higher ROI. So some people tell me, but then in the case of Disney, okay, I actually make $3,000 because 11,000 become 14,000. But on the option, my 1,000 only become $3,000. Okay, that is because I'm looking at the same contract, 100 share. If let's say today I'm willing to risk more on my option, I can actually go for 10 contract. So instead of 1,000, I can actually be putting about 10,000. So my 10,000 will actually become 30,000. So when you compare in that example, the option actually still make a lot more. Hope you understand this particular example. Okay, very good point. Okay, so now I'll answer some of your question. Okay, Adrian mentioned, what if the Disney price went down? Okay, what if the Disney price went down? So just now Disney was at 110. Okay, back to this. So just let me just go back to my previous slide. Okay, so Disney previously was at 110. So let's assume the worst case scenario. Okay, worst case scenario, Disney go bankrupt. Okay, how much will I lose in this particular example? If Disney were to go bankrupt, and I buy share, I will lose 11,000. Okay, if let's say Disney dropped to $50, so my 11020 become $5,000, I will still lose about $6,000. But in the option, okay, even if let's say it goes all the way down to 0, my maximum loss is still going to be 1,290. So how much you actually pay for this contract is going to be your maximum loss. All right, it's going to be your maximum loss. So the only risk in this particular example is if Disney, after 2 years, it remains the same at 110. Okay, if it remains the same at 110, if you're buying an option, it will actually expire worthless. So you are going to lose $1,000. But in the case of this, if you buy the share at 110 and 2 years later it remains at 110, your money still remains the same. There's no change. So like I said, option, again, there's pros and cons. The thing is you need to be correct with the direction. Okay, you need to be correct with the direction. Does the option price always correlate with the stock price? Pretty much, I would say 95% yes. When the share price goes up, your option price will also go up. Of course, there are certain special cases, but that is a little bit more complicated. That actually links to what Yao King has mentioned about the volatility. Okay, but that is a bit too technical. So that one, probably we can take it offline. Okay, I will explain to you guys. But pretty much, as long as the share price goes up, the option will also go up, right? So this is just to give you an illustration on how option actually work, okay, to gives you a lower capital outlay and higher ROI. Okay, so of course, as another example, but okay, because of time, I'm going to just skip through this few portion. Okay, I'm going to skip through this example. Okay, so coming back to the next one. Okay, so you realize that I have been talking a lot about US market. Okay, I've been talking about the US market and not so much about the Singapore market. Why is it so? It's because, okay, today if you want to short the market, if you want to use option is only available in a few markets. US, Hong Kong is one of the two largest option market. In fact, US I wouldn't even consider Hong Kong as a big market for options. Okay, so if you want to do options, US is pretty much the must go to place for option. So that is why actually when I shared with you, many of the case I actually use is based on US company. Okay, so for me personally, I'm actually invested, I would say almost right now is 100% in the US market. I don't even look at the Singapore market. Okay, because if I compare, later I'll share with you why. Okay, but when I compare Singapore market and the US market has a lot higher potential, okay, as compared to the Singapore market. So now coming back to this question, is US market risky? Okay, so some of the myth about the US market is this. I don't feel safe as it is far away. Okay, so coming back, don't forget that information is power and the internet has made it easy to retrieve information. Today, if I want to find out what Facebook do, I just Google. If I want to find out what Amazon do, I just Google. If I want to find out, is Amazon profitable? What is the cash flow of Amazon? What is the debt to equity of Amazon? All I need to do is just Google and everything can be found on the internet. Comparing this to 20 years ago, okay, in the past, okay, it is not easy for us to get all this information. If you are an investor 20 years ago and you need all this information, you probably need to fly all the way there, okay, and request this information from the company itself. But right now, at the click of a button, everything is on the internet and everything is open and transparent. So now it's super easy, okay. Next is very scary with the price movement, okay. Like I said again, high volatility or high price movement means opportunity for capital growth. Okay, when the stock is not moving, basically you cannot make money. When the stock is very volatile and you have the knowledge to actually get it correct, you can make a lot of money. Okay, huge opportunity. And the last one, difficult to access. So some of us might be, we have not invested before. I do not know how to invest in the US stock. Okay, basically there are local based US brokerages which I can share with you guys. Okay, so all you need to do is open an account with them. In fact, they have office in Singapore as well. So it is very, very convenient. And there is one that is also regulated by the MES, by the Monetary Authority of Singapore. So they are very, very safe, in short. So some of the facts about the US market. Okay, US has more than 7,000 companies for you to choose from. Okay, companies that we are familiar with: Apple, Starbucks, Alibaba, Amazon, not Taobao. Basically anything, your HP, even all your Gucci, Louis Vuitton, everything is listed in the US stock market. All right. So well regulated by authorities. So they are one of the highest regulated places. Okay. In fact, if you compare Singapore to US stock exchange, I'll say that the US is even more regulated than Singapore. So okay, don't quote me. Okay, but anyway, this is what I feel. US is highly regulated. So that's why it's very difficult for any company to be listed on the US stock exchange. So you need to be of certain size. You need to have certain record in order for you to be listed over there. And of course, the last one is huge opportunities for capital gain. So that's without a doubt. Okay, so if I compare these two, Singapore versus US, okay, so just make a quick guess, the orange line. Okay, just type into the chat group, the orange line is Singapore or US? Type in the chat group, the orange line, is it US or Singapore? Okay, cool. I see that most of you guys actually got it perfectly correct, okay? So yes, the orange line is actually the US. So we can see that from 2011, okay, 2011, okay, all the way to today, the US market has been going higher and higher and higher and higher and higher and higher and higher. Okay, breaking new high, constantly breaking new high. Whereas if you look at the Singapore market, okay, unfortunately, I just want to share with you that the recent market high for Singapore market is even lower than back in 2007. Okay, which means that from 2007 up to today, the Singapore stock market has not broken the new high. So literally, we are not growing for the past 10 years. All right, in terms of the Singapore Stock Exchange. So if you ask me, these two, which one would I go to? Definitely 100% US market. So now I've been talking a lot, right, about why people make money, how you can make money, you know, looking at the trend, looking at a good company, shorting the company, you know. So the next thing I'm sure in all of you in your mind is, so Bowen, why 80% of the people actually still lose money in investing? Okay, you make it sound so simple, like this, it's a no-brainer. Anybody on the street can make money from the stock market, but why is it that still so many people are losing money in investing? All right, so that is where I want to share with you this very important concept. Okay, so this is the part whereby you guys really need to wake up. So if you need to wake up, okay, just pinch yourself for now. Okay, very, very important concept coming up. All right, so this is a story, okay, between me and Mr. G. Okay, so this is my story and Mr. G's story. Why do I hear some voices? Okay, let me mute you guys. Okay, cool. This is basically my real life story. So back in 2011, okay, I started investing. In fact, I started investing about 9 years ago. And where did I invest? I invest in the Australia gold market. Australia gold market. So at that point of time, as you can see over here, that was a bull run. So everything is going up lah. So I was making a very decent profit, okay, investing in the Australia gold exchange. So what happened is that when I started to make money, right, what happened is naturally greed overwhelmed me lah. So I started to become greedy. So I started to think, how can I actually make more money from the stock exchange? So I started to leverage. Okay, I started to borrow money from the brokerages, okay, to invest. And what happened subsequently, as you can see in the PowerPoint slide, is there was a crash. Okay, there was a crash. Okay, so when you leverage plus a crash, okay, that is not a very good combination. So what happened is that I received this thing called margin call. Okay, so when you receive a margin call, two things that you can do. Number one, if you don't do anything, your account will be wiped out, literally wiped out. Okay, the second thing that you can do is to top up more money into the account, so that you will not get this thing called a margin call. So for me, when this happened to me, I was 23 years old. So do you think I actually have more money to actually put in more? Of course, no lah. So what happened is that I let them wipe out my account. So that happened back in when I was about 23 years old. Okay, it was quite a substantial amount, but again, that was my first learning lesson. So after I lose so much money, right, then I started to wake up like, hey, how come other people out there are still making money and I am losing money? Okay, so actually there was a period of time I actually stopped investing, because like most people, I also believe that the stock market is risky. Stock market is not for me, it's only for professional. You need to spend a lot of time looking at the market. But then I realized that no, there are still a lot of people out there that are consistently making money. So that is why I decided to look for a mentor. Okay, to actually pick up a skill, to really learn. All right, so this is my friend. Okay, so I actually met this friend back when I actually learned from this school. Okay, so this is my friend investing methodology. His methodology very simple one. Okay, so he has 25,000. So what he did is he split this 25,000 into 5 different companies, A, B, C, D, and E. So A makes 15%. So the percentage is an illustration. So A makes 15% every single year. B makes 5% every year. C, no change. D, -5 every year. E, -15 every single year. So 20 years later, okay, let's make a guess how much this money would actually become. Okay, so you have 3 options. The first option, more than 25K. Second option, remain at 25,000. Third option is less than 25,000. All right, so I'll give you some time, think about it, okay, and then put into the chat group. Okay, if you believe that after 20 years, 25,000 will become more than 25,000, put 1. If you think it remains at 25,000, put 2. If you think it will drop, put 3. So only 1, 2, 3. Okay, then let's take a look at okay, wow. Everybody say more than 25,000, more than 25,000, more than 25,000. Anyone have a different answer? No? Final 3, 2, 1. Okay, close. All right, so let me release the answer. Okay, so 25,000 putting into this 5 company 20 years later. Okay, what is going to happen is, yes, you guys are awesome. Okay, 25,000 actually grew 4 times to become 102,000. Okay, 25,000 actually grew to become 102,000. So why did this happen? Okay, very simple. Okay, let's imagine, okay, one of the company, he put 5,000 in. That is company E. So company E dropped by 15% every single year. Let me ask you this question. What is the worst that can happen? How much can he lose maximum? The answer is 0. So he could have invested into this company called High Flux or Fujifilm or Lehman Brothers. back in 2007. And the worst thing that can happen is 5,000 becomes 0. Can you lose more than 5,000? The answer is no, you cannot lose more than 5,000 unless you actually put in more money. Okay, so this is very important. You cannot lose more than 5,000 unless when it drops, you actually put in more money and it continues to drop. Right? So now the next one, if I put 5,000 into company A and A grew by 15% every single year, what is the best that can happen? Okay, so what companies can grow more than 50%? It can be company like Disney, it can be company like Apple, it can be company like Facebook. Okay, all these companies that I have mentioned, they have grew more than 15% year after year. In fact, it's in the range of 20 to 25%. All right. So are we familiar with all these companies? Yes, the answer is all these companies doesn't have to be alien. Okay, in fact, we all use their product. We all look at them every single day. Okay, companies like Facebook, Disney, or even Apple. Even right now, I'm using my MacBook Air. Okay, so if you put 5,000 and it grows 15%, after 20 years, 5,000 actually grew to become $81,833. All right. So again, is this the maximum? The answer is no. If you leave it there, 81,000 will continue to grow to become 100 over 1,000, 200,000, and over a few more years, it could even become 1 million. Okay, if we just give it more time, more than 20 years, it could even reach $1 million. So $5,000 can actually become $1 million as long as you compound it over a period of time. Right. So using this example, okay, I just want to illustrate to you this particular point. Okay, investing gives you limited risk and unlimited returns. Okay, so a lot of people say that why investing is risky. Investing is risky, but again, if you look at how investing is being structured, it has limited risk and unlimited returns. Okay, but all you need to do, you realize like what my friend Mr. G do is he has a system, he has a structure, okay, to it. So that comes to this particular point that is very, very important. Always remember why people actually lose money in investing, because they have no proper system of evaluating and investing in shares. They are always using this thing called feeling. Okay, the feeling telling me that it will go up, feeling telling me that it will go down. Okay, but again, okay, the market is moved by emotions. Okay, what we want to do is we need to have a proper system in order for us to profit. So because we do not have the proper system, hence we always buy into bad companies based on the decision on hearsay. Okay, so remember just now I mentioned that the first thing that we want to do over here is we want to make sure that we buy into a company that is stable. Okay, that is stable. So we do not want to even look at companies that are bad, unless there is current situation whereby we are trying to short the market. Then we are looking at companies that are highly affected because of this crisis. Other than that, in normal days, we are expecting the share price to go up. We want to invest in companies that are, okay, stock market is open now. We want to invest in companies that are good. Okay, next up, okay, people tend to overpay even when the companies are good. So in normal days, okay, in fact, I don't really share about Singapore companies. Why? Because most of the Singapore companies, I agree that they are really, really solid companies. Okay, many companies in Singapore, they are really solid, good cash flow, good profit. They give very good dividend yield. But only one thing that I don't like about Singapore stock market is they are expensive. Okay, most of them are expensive. Okay, but right now, current market situation, 80 to 90% of the Singapore stocks are relatively low price. I wouldn't say that they are very cheap right now, but they are relatively low price. Okay, relatively a reasonable price. So that actually got me interested also, okay, to start to look into the Singapore stock market. And that is actually one of the key reasons why I set up this Telegram group and why I actually do all this video, is to actually encourage more people to start looking at Singapore stock market. Okay, because you don't have to overpay a good company at current market situation. Now coming to number 3, okay, people always take profit too early in the stock market. So this is also one of the biggest mistakes that a lot of people make. For example, okay, let's assume that over the next 6 months, we all buy into solid Singapore companies at a very low price. Okay, but how long are you going to hold it? Okay, people are already asking me, Bowen, so when can I actually sell away my stock? When can I sell it away? So there are people that sell away when they make 20%. There are people that sell away when they make 50%. But I can tell you that the richest investor in the world, they don't sell away their stock. Why Warren Buffett is so rich today is because he just constantly buy more and more share. When you have a company, when you buy a good company that is making money for you, the thing is, why do you want to sell it away? You want to collect as many as possible. Okay, so when you have a company that's constantly making money, keep it there. So like the company A, if you invest in Apple, Disney, or even Facebook, all you need to do is buy, leave it there, do nothing, and as the share price goes up, you make more and more money. So why a lot of people didn't make that kind of wealth is because they actually got out too early. They got out too early. They take profit too early in the stock market. So coming to the last one, which is number D, okay, they have no inbuilt system of safety. So if you look at what my friend Mr. G do, okay, it is very simple, but it's very smart because instead of putting his money into one company, he put it into 5 companies. Okay, he put it into 5 companies. So you can see that what he did is he actually diversified. So out of that 5, in fact, all he needs is that number 1, is that company A that grow 15% for 20 years. Even if the other 4, B, C, D, E, all lose money, all go bankrupt, his 15,000 will still grow to become, no, his 5,000 will still grow to become 81,000. So overall, his portfolio will still be positive as long as he has that one company that grew over 20 years. All right. So you don't have to be correct. So a lot of people say that you need to be correct in most of the time. You need to be more than 50% correct. But in reality, is you just need to have that 1 or 2 correct, and you hold it long enough. That one profit is going to cover all your other losses, and you're going to make a lot of money if you just have that one company. Okay, so like in the case of my friend that borwen 8,000%. So even if 8,000% literally means that he made 80 times lah. So even if he has the next 79 company that he invested in all lose money, he will still be profitable because that one company helped to make 8,000%, which is 80 times. So that is how crazy it is. You just need to have that one that make massive amount of profit. So remember that it's actually a proper way to profit from the stock market. So this is the 3 investing principles that you need to take home today. So this is super important. Okay, number 1, you need to diversify. Okay, and number 2, you need to cut your losers. And number 3, you need to let your profits run. All right. So this is the 3 things that you need to do. Okay, so you guys can write it out or take a photo or do anything, but just remember these 3 things: diversify, cut your losers, and let your profits run. So what I do, or what we do in Ultimate Investing, is basically revolving around these 3 concepts. Okay, so for us, what we do is we actually have this thing called a 30 days investing challenge. So basically every single month, okay, me and my students, we actually record down all our trades, and then we actually take a look at how well we perform on a 30-day basis. So this is what we did. I think this was about a few months back, but I just want to use this as an example to show you how we implemented the 3 investing strategy. So let's look at the first one. So for me, you can see on the right hand side, I have a starting capital of $10,000 for this challenge. So I allocate 10,000 for this challenge. So in the middle, you can see this thing called a buy amount. Okay, buy amount, and then you see $820, $885. So on average, you can see every single entry that I did is close to $1,000. You can just go down the list on the buy amount. You can see that it is around $1,000 or less. So what I do is every single entry is about 10% of my starting capital. So if today I have 100,000 for this 30 days challenge, so basically this buy amount is going to be still 10%. So it's going to be about $8,000. So everything just add 1 0. So I just multiply the number of contract by 10. Literally, it's the same thing. So the next thing you want to look at is the second one, which is cut your losers. So you look at those that I actually lost money, which is the red color one. You realize that my losses are somewhere in the range of 25%. So every time my stock drop 25%, what I'll do is I will cut it away. I will just cut loss. Okay, so when my stock dropped 25%, I would actually sell it away. Why is it that 25% I will sell it away? Is because human psychology works this way. When you lose 25%, it is your mind is still logical enough to sell it away. But the moment you lose 50%, okay, can you imagine you bought into this company ABC and ABC actually dropped 50%, and now I tell you to cut loss, you will be like, wow, I think I don't want to cut. I already lose 50%. I think I'll just wait for it to recover. So when you're already at 50% loss, you will actually have this thing called a hope. You hope that the 50% will recover back, okay, to become 100%. So let's assume that the market go against you even more. So 50% losses now become 70% loss. So let's say you put 1,000, 1,000 now only left $300. All the more you won't cut loss. Why? You will have this mindset that I'm only left with $300. My worst that I can lose is 300. But if I hold it, there's a possibility that I will get back my $700. So you will continue to hold. Then the stock dropped further until minus 80%. So left $200. Even worse, then you say, yeah, I only left $200. Yeah, just leave it there. Don't even want to look at it. Left $100. Okay, don't even look at it. Then 6 months later, you forget your account. Okay, and then one day you suddenly remember, hey, I think I still have my stock. So when you open the account, you have this hope that, well, maybe something magical happened. It goes back to $1,000 or it becomes $2,000. And then you realize that it's only left $50. Okay, so this is exactly what happened. But when your loss is 25%, your mind is still logical. That is where you need to get out of the stock market. Now we look at the last one. Okay, let your profits run. So that is where we focus onto the ROI portion on the green color. You realize that most of the ROI is above 50%. Okay, most of my ROI is above 50%. So what I do is, if my losses is 25%, if my cut loss is 25%, I want to make sure that I take profit at minimum double. Okay, minimum double. So which means that at least 50% I will take profit. So why do I want to do this? Reason being very simple. So let's say today I have 10 stocks. Okay, 5 of them I got it correct. 5 of them I get it wrong. So which means that out of that 5, each of them I'm going to lose 25%, 25%, 25%, 25%, 25%. But for the other 5 that I'm correct, I'm going to make 50%, 50%, 50%, 50%, 50%. So overall, okay, what do you think will be my profit? Will it still be positive, neutral, or negative? Okay, put into the chat as well. So if I have 5 of them, I cut loss at 25%. The other 5, I make a 50% profit for each of them. What is going to be my overall portfolio? Will it be positive? Will it be the same? Or will it be less than my original amount? Okay, just put into the chat group. Okay, positive, 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 positive. Okay, if you want, you can just write down, use a number, and then you're going to calculate. But basically, yeah, you are right. The overall will still be positive. Okay, you will still be looking at quite a decent amount of profit. So you can see in this particular example that I just shared with you, right? You don't need to be correct most of the time. In fact, if you are right just 50% of the time, if you have a system, you will be profitable. But if you don't have a system and you're always depending on your feeling, then it depends on your luck. If your luck is good, maybe you make money. If your luck is bad, then you blame it that year your feng shui is not good. So that is the thing. Always have a system, especially when it comes to investing in the stock market. So you guys are perfectly correct. Okay, so positive is going to be positive. So having a system is important. So basically, I do this on a monthly basis. So every month I will record my 30 days investing challenge. And so far, I'm constantly looking at a range of about 10 to 30% monthly returns. Okay, monthly returns. So in fact, for the month of March, I was looking at about 48%. In April, okay, it is still ongoing, but this month has been my best month because I have been, unfortunately, I've been shorting the market. So this month has been pretty one of my best months. So last month in March, I was looking at about close to 50%, okay, on a monthly basis. So this is crazy returns, okay. So, okay, for the past few hours, okay, for the past I think two over hours, okay. I hope that you guys are learning something. If you are learning something, just type yes, I am learning. Just type yes, yes can already lah. Just type yes, so I know. If you're not learning, just put no lah. If you don't know, put to no. Okay, cool. Well, this one I must make sure that everybody type yes. I'm supposed to still have how many people? 34 people, but it seems like only 10 people are replying. Okay, gotta make sure that everybody is still here. So for those of you, if you are learning something, just put yes. Okay. Okay, fantastic. Okay, so let me just move on. I think I've seen quite a number of yes. Okay, but of course, I just want to share with you that as much as I want to share with you, and of course, we have the Telegram group to support you guys. Okay, but again, there are so many things that I want to share with you, but some of them are more technical, so I can't really go through everything in such a short seminar. Okay, so I really appreciate those of you who actually stayed all the way until today, until right now. It's about 9:40. So I have a gift for you guys, for those of you who actually stayed all the way until right now. Okay, but before I give you the gift, okay, I just need a help from some of you guys. Okay, please go to Facebook, okay, and like our Ultimate Investing group. Okay, please go to Facebook, search for Ultimate Investing, okay, and then like this particular Facebook page. Okay, why do I want you to like this Facebook page? Is because, okay, if you have any question, with regards to whether you want to enter the market or anything with regards to the market, all you need to do is go to this Facebook page and then drop us a message. Okay, and then we actually will reply you through this Facebook group. So this is actually a way for you guys to actually connect with us and also to answer any of your questions after this special Zoom session. So please like our Facebook page. This will also be a way of communication between us and you guys. Okay, and of course, this is the gift that I have for you guys. Okay, people who wants to invest in the Singapore stock market, I have the 30 companies. Okay, there are many amazing companies that you can invest right now. Okay, go to this t.me/ultimateinvestor.sg. This is a Telegram group. You won't be able to type anything inside. Okay, so this is a one directional, so we'll be feeding you a lot of the things that we are looking at, the news, some of the things that we are going to buy, whether is it a potential entry to buy any of the Singapore stocks, everything. Okay, without hiding anything, we are actually sharing everything inside this Telegram group. So super powerful. Share this with your friend as well, okay, so that they can actually benefit from it. Okay, so again, okay, this is for Singapore stock, Singapore market. So for those who wants to find out more about investing in the US market, who wants to find out more about shorting the market, how do you benefit from the short-term bear that is still ongoing, okay, before it reached a 50% drop. All right, then this is another resources that I just want to share with you lah. This is the last part, okay, is to actually join us in Ultimate Investing. So you can see that for us, okay, Ultimate Investing is actually set up by me, Ivan, and Paul. Okay, we are the three co-founders. So what we do is we actually invest in all directions. So whether the market is going up or whether the market is going down, okay, we are able to benefit from it. Okay, but again, we specializes mainly in the US stock market. So if you want to, delve into the US market, you want